Live streaming is on.
All right, everybody. This is Event Trader here, Gavin McGuire, and we are joined by Brandon Mars, options trader, for what's now going to be a weekly discussion around options around the markets. Just getting Brandon's perspective. He's pretty savvy. Gent understands what's going on in the markets and brings a nice perspective to us, especially on the options side. And that's kind of really where our focus is going to be. So today, we're just going to talk to Brandon a little bit about some of his most recent trades, as well as taking a look at the overall broader markets. And then what we're going to do is talk a little bit about using options for hedging your portfolio just by playing with the SPYs and the Qs, but also looking at some daily trading potential that these offer now with the zero date trade options that they have out there. That could you definitely see more and more usage of it, especially if you break down any of the institutional um, newsletters where they're talking about it and they're just using it at a much greater pace. So, without any further ado, we are going to call in Brandon right now. Brandon, how are you doing?
I'm great, Gavin. How are you?
I can't complain. Can't complain. Just kind of watching this market chop around like everybody else. It's been pretty interesting. Every time it feels like we're going to get a break, bulls come in and break lower, bulls come and defend, and vice versa on the upside, right? So haven't really been able to forge outside of a direction, and it seems like when we do, we're thrown right back into it. About one or two periods later, is from what I'm seeing. What's your general sense on the markets here, Brandon?
Yeah, I mean, it's choppy, just like you said. I mean, I put this in my morning comments and I'll reiterate it now. I mean, I know there's a lot of people that are out there that are, kind of just starting to dip their toe in the water of options. And I'll say this is not an easy environment by any means. There's certainly some big movers, like an AMD this morning, NVIDIA yesterday had a nice move. I mean, there's moves that are creating these pretty profitable options trading opportunities, but they're not necessarily easy to read at certain times. You've got, in certain cases, the market's going down yesterday morning while the semis are soaring. You got markets that look like they're rolling over now. And like you said, when you think you're getting going in one direction, the rug gets pulled out from underneath you. So, I'm sure that there's some discouraged people out there. And, I get it. It's not an easy environment for what that's worth.
Yeah, no, it's very difficult. I mean, just price action, just every time you think that you're going to get a move in a certain direction, it seems to just whip back on you. And that's always tough to try to figure out exactly where we're going. And then just kind of the oddity, too, of moves where so much of the buying is concentrated in stocks that have already run a bunch, and it's really difficult to kind of chase after that. Now, I did see that you took that you bought a call in Apple, the 172.50s. This was yesterday afternoon. You held them overnight and got a nice move in them. So you trimmed a little this morning, but why don't you talk a little bit about your Apple position here, Brandon?
Yeah, so Apple, I mean, it's just one of those where it had that nice move after earnings, and it's just kind of been trading sideways, and it just kind of felt like it was maybe due for a little bit of the catch up. I think one challenge with Apple is it's such a heavy weighting that when you have this choppiness, I'd say that Apple in particular gets some elevated gains. You kind of get that on any of the big tech stocks because, frankly, they can use Apple to, I don't want to say manipulate the markets, but maybe a little bit. I just kind of saw, that nice move, and it's been consolidating. And it seemed like, if we were going to kind of take that next leg higher, you got the semiconductors yesterday. I mean, you're getting those again today. You've had some moves in Google. It just kind of seemed like it might have been its turn to go. So it's showing some strength underneath, but again, just every time the market gets hit, it just kind of gets slammed back, and it's getting a little bit of choppiness here, similar to the rest of the market. And yeah, that's definitely kind of been an afternoon challenge when it comes to options. Is some of these big tech names, it's like they're pinning them on a Friday, which has not made life easy in certain cases.
So what you're saying when they're pinning on a Friday, can you just explain that?
Yeah. So, basically Apple's at 172.25 right now, let's call it. Let's say that the most options were traded at the 172.5 strike throughout the week. What they'll do is they'll essentially pin the stock at that particular price. And essentially it's just them killing off options in a way. You've got all your institutions, your market makers, and they're basically hedging all of their bets of options that they've been purchased and that they've written throughout the week. So you'll kind of get that back and forth, a balancing of books, and then just frankly to kill off option premium. So, for an environment like this, the option market makers, they love this. If it trades sideways, that's what kills off the premium, kind of like we talked about in the covered call segment last week.
Right. So for their perspective, then, Brandon, do you find that let's say that they try to just kind of put out additional options there just to kind of keep that pegged to that one spot so you're saying pinned, obviously. So when do they start kind of trying to decide where they want to pin options to? Have you ever kind of noticed the pattern on that?
Well,
and if so, is there any way of playing around that for you?
It usually feels like it starts on a Friday, but with this week and just the ongoing choppiness, it feels like it's happening already. So basically there's a thing called the max pain point, which is essentially where the option, writers can pin the stock price where it will create the most pain for the option buyers. So, as the week goes on and you start to get, more and more flow on particular strikes, that's where you'll start to see that balance. As far as taking advantage of that, there's definitely ways to do it. It's kind of a tough game. You're talking about trillions of dollars of underlying options value. If you're really unrolling the true derivative, you're talking about trillions of dollars worth of value, and you're kind of going up against the big institutions and market makers there. And as much as I love to think that, my massive account size could, move markets, I don't think I can really beat out the market makers when it comes to the swaying of the Apple stock price, unfortunately.
Sure. And if there was ways around it, everybody would be doing it, and therefore would be ruined, right?
Yeah, exactly.
And these guys, they're not making $1 billion a year for their health, right? It's definitely a game system on that perspective.
It's not their first rodeo. Exactly.
Somebody wrote in, I don't know if this is true, is 85% of options expire worthless. Is that true?
Yeah, it's right around that number. Yeah, it's pretty crazy when you really boil it down, how many options out there truly expire worthless.
Is that simply because at some point somebody buys options off people just to kind of hold them to keep it pinned and they're okay with it?
That is
worthless.
Yeah, that is definitely part of it. And then, I think a big part of it too is you definitely get your speculators out there that are going up and they're buying, 1,000 contracts at a penny a piece. Yeah. So, but yeah, there's that number sounds pretty close to the numbers that I've read.
All right. So I was going through your morning notes and was certainly interested to see you had a couple of call ideas out there and a couple of put ideas out there. And obviously the call ideas were concentrated in the tech side of things, while the put ideas was more on the healthcare side. So is that something you're just obviously seeing in the broader sector analysis? You were a little concerned with how healthcare is working while you're just riding the wave in tech.
Yeah, I looked at the two charts, and I love when you find a sector setup, just because obviously if they all break at once, you're going to get a larger break, which in theory with options is something that you want. I just saw Johnson & Johnson and I saw UNH, and they were both kind of hanging out around the 50-day moving average. So, they're the top two holdings in the XLV ETF. So if they broke together, again, in theory, it would be a pretty nice break. So I was kind of looking at that and I saw, well, hey, if they both broke, and then at the same time, the Dow just continues to be the weaker index. it's not the greatest chart on the Dow. I think actually the Dow is now below its 50-day currently. I would need to just double check that, but it's been flirting with the 50-day as well.
Yeah,
and
it's below
I was
the
just
50 and coming in to test the 200 here at 33,000 basically.
Okay, perfect. Yeah. So, I just kind of looked at those, and they just kind of continue. The Dow just continues to be really, really weak. I've been watching it a little bit more recently, kind of looking for some of that breadth. And, if you look at UNH, let's see here. Look at that from the open. I mean, that thing has just been sold off since the open, to finding a little bit of base right around the lunch hour at a little spike. But that's some, you probably see some of the tick data and better, a little better than I do, but that's just some pretty solid downtrend in a stock. So I saw those things, and that's kind of what made me lean towards those factors. Nothing in particular that I was seeing like in the healthcare space per se.
Yeah, and I mean, I'm obviously looking at the Dow. You got Microsoft in there. That's at a 52-week high. CRM, are you still involved with Salesforce? They expired on Friday, right? Your contracts?
I am not involved with that. I do still like the chart. Salesforce, I mentioned this last week. It can be a little bit of a pain to trade. And I've just found that since it's entered into the Dow, that it sometimes has a little bit of a funkiness and difference to it, trading as a tech stock. I do like this chart. And actually, as I look at it, it is kind of shaping up for a fairly nice bullish engulfing candle right now. A lot of time left, and that could change in 5 minutes. But that is actually looking pretty good. That might actually be on the radar for tomorrow as I look at it.
All right. Obviously, a Home Depot, a big drag on the Dow today, too. One of the other names that's down that we could just kind of circle back and chat about was Caterpillar, which, of course, you had that covered call strategy for Caterpillar, which I believe you were talking about putting it on around that 210 level, right? So it's starting to edge down. You got any thoughts, if for argument's sake, you did put that covered call in, like what you're thinking would be right here?
Yeah, so if you were in the 210, I might stick with that actually, because you're at 208, and I think the next strike down is the 207. So you'd collect more premium for doing this, but you're writing your call in the money already. So if you were looking to exit the stock and you didn't care about losing your shares, then I might potentially do that. Otherwise, I might sit a little tight and maybe see if it would push down to, call it the 205 area, and then maybe roll my strike down to the 207.5, because the triangle's breaking. I mean, from a technical standpoint, this thing looks like it's ready to go. I would say, though, and you probably know this a little better, I think Deere reports earnings this week, if I'm not mistaken.
They're out Friday morning, correct. There is concern around the Deere earnings. So I wouldn't necessarily view that, and you can see Deere, very similar chart, that's breaking down as well, down to that 364 area. So I wouldn't say that people are afraid that Deere is going to post a strong report. So now, of course, the problem is when you get into a situation like that, you're selling off going into the report. People are expecting a kind of a poor report. What happens, number one, if they surprise to the upside, or number two, they post that poor report, the stock just kind of sits there, right? That's generally going to be your biggest fear.
Yeah, and I mean, in this case, if you're writing the covered call, if Cat were to follow Deere and it were to just sit there, that's a great strategy too. That's kind of almost your ideal scenario, where your stock isn't going down, which can always be annoying to watch, even if you're hedged. So if it were just sitting there and it were killing off that call premium, that would work well also. So, if you were really bearish on Deere and you just said, hey, this thing's going down for a reason, and the earnings report's going to be, the final straw, and it's just going to, really take a deep dive, then I might maybe consider rolling down my option now and collecting a little bit more premium, because in theory you would write it now and Caterpillar would probably follow Deere down to, call it the 200, 205 level, maybe, if it did have a poor report.
Okay. All right. Quick question for you, Brandon. You had brought the Amazon calls, the 115s, a couple of or last Thursday. Uh, Somebody's just curious as to is there any particular reason why you didn't get back into that trade this week?
That's a great question. And
I would say I always kind of get a little not annoyed, but I mean, if you're looking at hindsight being 2020, obviously, if you knew that it was going to rip up 2.7% here, then you would have. But there had to have been something kind of weighing against you. Is there anything in particular on it?
well, I actually have on my, so I don't post every stock that I'm watching each day, just because it would end up being a lot. But if you
Sure.
look at my list of potential things to buy calls on today, right there at the top of my list is Amazon. So I actually did like the setup going into today. I just frankly missed it. There's just no other way to put that. I think the chart does look good. Maybe after this move today, as it kind of touches upon that upper Bollinger Band, maybe it's due for a little consolidation, but the chart's looking pretty clean to me, and it's a nice break. It's got some fairly decent volume going today. I just didn't get in on that one, unfortunately. That's kind of the challenge too, is which stocks do you pick for your options? And I just missed that one.
Yeah, no, I mean that happens for sure. Especially, we're not going to catch every move in every market for sure, but the whole point is trying to generate ideas. So hopefully there was something that the sub saw in Amazon and they went ahead and purchased it. You don't always have to wait for the traders to make a call. Obviously, they're providing their best commentary around charts. And trying to find the best ideas for sure. But sometimes when you're mentioning a couple of stocks, there's a few that are going to jump out that you're going to miss, unfortunately. But you had that pointed out, as you said, so that's good information, and hopefully some people were able to act on it. So, all right. So, anything else on the trades that you currently have? Is there anything that you got in the hopper that you're looking at that you haven't mentioned on the site yet, Brandon?
Nothing in particular. I mean, with this market environment, even if I were to try to do my research for tomorrow, this afternoon, by the time the market's closed, I feel like it's got potential to change so much. So kind of wait for those, the final bell there, and to, let the candle for the day settle so I can see what's going on out there. But yeah, I mean, you would think if you look at some of these names and, kind of what we're going to talk about, there's just such a split. I mean, I'm looking at the potential calls I was looking at today, and half my list is green, half my list is red. And I have a bunch of different watch lists that I have that are split like that. So, you would think that if this were to continue higher, that, you'd likely maybe see a name like an Apple or a Meta that would kind of need to step up for the rotation over the remainder of the week. And again, there's a lot of trading to go today. So, I'm not saying that's going to be my idea for tomorrow, very much subject to change. But you would think a stock like an AMD, after up 5%, and NVIDIA, that you'd maybe see a little breather in the semis. And, if we're going to continue on higher, like an Apple or a Meta, I think would need to kind of step up to continue lifting us higher.
Yeah, and I mean that's basically been doing most of that work, as you said, Brandon. I mean, we are down slightly on the session. I mean, just looking at the S&P, we're down 0.31%. The Nasdaq, we're up 0.5%. What's amazing about that is how much stuff you're seeing in the red right now. I mean, the advanced it's 2-1 on the Nasdaq in for declining issuances. So there's 2,916 declining issuances. There's 14,007 advancing issuances, but we are up on the day. It really just kind of highlights how much money is concentrated in those big cap names. I mean, just looking at some of the different sectors that I follow here, the only things that I'm seeing in the green are the semiconductors the XLK, which is 40% Apple and Microsoft, and the MGK, and then the XLY, which is also pretty heavily favored on Tesla. Everything else that I got out there, Brandon's in the red, and just really goes to show how much concentration are going in some of those top names.
Yeah, absolutely. And that kind of makes me think of something on Amazon. I mean, if you look at the SPY this morning, I mean, you know, you had your gap down, a little bounce back, and then, you know, it moved lower. And, you know, I had a lot of things on my screen that were red. And sometimes that makes me think, hey, you know, maybe I shouldn't just jump all into, you know, these big tech calls. And then all of a sudden, you know, you see the market turn and, you know, Amazon's made its move and you might not want to necessarily chase it. So, you know, that's definitely something that happens to me as well. And I think that's just me, frankly, having been burned once or twice in the first 30 minutes of trading. And, you know, sometimes you miss those great opportunities by not jumping on board right away. I mean, Lamb Research I recommended yesterday, you know, that ended up moving up 4 or 5%. And, you know, it just moved so quick and it made its move. And I hadn't hopped on in the first 30 minutes and I still could have made good gains on it. But I just didn't want to chase it. And, you know, frankly, I missed it and I just got to move on and find the next one.
All right. So with that, our discussion, our focus this week on just kind of the options education side is going to be looking at the SPYs and the QQQs here. And we're going to discuss two different things. One, day trading them with the zero dated options that have become so big in the market. And then also just using it as a hedge to protect your portfolio, especially at a time where you're concerned about the markets going down. Obviously, Brandon, right now is an interesting time with that debt ceiling, and you really get the feeling that people just kind of want to protect against a drop down, but nobody feels like we're going to default on the debt. And I feel like everybody's just kind of waiting around for a potential buying opportunity. How that impacts trade is going to be interesting, but it does set up for a scenario where you might not want to sell any of your stocks. And, you know, that's obviously its own form of hedging, reducing your risk there. But you do want to buy some sort of derivative that will give you a broad protection against the market declines. So that's going to be our focus on this. So I guess with that in mind, again, the focus is going to be on the SPYs and the Qs. Brandon, do you have a preference on SPYs versus Qs? If you were to use this as, and we'll just kind of use it as a portfolio hedge first, and we'll look at that aspect of it first. If you were to use that for a hedge, how do you decide which one to go with?
If I were to do it, I'd probably end up looking at the SPY just because simply of the fact that the Qs have been so strong with such flows into the tech space. I mean, you know, obviously we could see a rotation on that at any time, but the SPY just feels maybe a little bit more vulnerable to me. Now, granted, if everybody hit the panic button and everybody wanted to pile out of those longs in the big tech, then you might want to maybe switch over to the Qs. But for me, it's just looking at the chart. And yeah, I think just the SPY at the setup right now, it's just kind of floating along that 20-day. You know, it's got some support in the 410 area. But if people really got scared, that seems like it could make a very quick move down to the 50-day, which would, you know, obviously be a very nice options trade. So that's how I would currently look at it. And then I'd probably get, like I just said, a little bit more intrigued if all of a sudden everybody hit the panic button. You know, maybe if we saw like yields spike up and, you know, everybody said, oh my God, I just looked at my portfolio and I'm 95% tech. I got to run. Then I might switch over to the Qs.
Yeah, because I mean, the one thing that I suppose is if you are looking to use it as a hedge, you certainly should be looking at your portfolio and just seeing where your concentration is, right? Because you know, it doesn't make much of a sense to hedge with the Qs if you got a bunch of energy names in your portfolio, right? So that would be one aspect. Would you find yourself in a position of hedging in both, just to kind of make sure you got a full protection there?
You know, for me, I just, and this is a little bit of a personal choice. I mean, I try to somewhat limit my hedges. just because, at the end of the day, I mean, if the hedge, if it's sitting there, there's a very good chance that that options contract is going to be worthless come expiration. So I try to not pile the number of worthless contracts up too much, because it's not good psychologically on a Friday.
Sure.
So yeah, I probably look at my portfolio in the chart, and yeah, I mean, that's a great point. A lot of people are loaded up on tech. So in that case, the Qs might make a little bit more sense.
Do you ever look at like a bifurcation of it where you might protect against, say, the SPY breakdown, but take advantage with a call in the Qs? Do you ever try to get cute like that, or do you just simply view that if you're looking to hedge it, you don't want to try to get a little too cute? You just want to protect yourself, and that's the sole purpose.
Yeah, I've found that usually when I try to get too cute with options, I end up kicking myself at the end of the day. So I try to avoid that, as much as possible.
Which again explains the Amazon piece, right? There's only so many options that you want to buy, that you want to manage, right?
Exactly. As I think I mentioned this in presentations before. I mean, as a young trader, I had a Friday afternoon one time that I looked and I had like 20 open contracts or something, and it just made no sense. It was like puts on Dow stocks and calls on tech stocks, and it made no sense. And from a management perspective, it didn't work. And I think if you do that enough, the days that all 20 of them work are fantastic, but that's few and far between.
Yeah, no. Chances are you end up flat on the session and just have a whole bunch of headaches.
Pretty much
is how that seems to end up. So, so when you're looking at protecting yourself here and looking at a hedge, what's your game thought in terms of the time decay, and how you're looking at how far out do you want to buy these options? For instance, I'll throw out a couple of examples at you. So let's say I'll give you 3 different examples. Number one, you're concerned that Powell might say something very hawkish on Friday when he speaks that you think could potentially break the market, and you're concerned about some of the upcoming earnings this week after the Home Depot clunker. You're worried that Walmart and Target are all going to miss. So that's option one. Option two is that you're worried about this debt ceiling debate, and that we're going to get down right to the end of May, and there's not going to be any deal. Both sides are talking default. Credit default spreads are flying on the mark on the dollar, and you're worried about getting a little puke before the end of the month. And number three, that you think maybe they are going to come to some sort of kick the can resolution on that debt ceiling, or perhaps even you're just worried that Q2 earnings are going to be really bad, and you think that we're going to get, say, a summer swoon either in front of the debt ceiling or around Q2 earnings. So you're basically looking at 3 different time frames where you feel pretty confident that the market's going to break down. The one being the end of the week, the other being the end of the month, and the other one being called midsummer. How would you be looking at those options in terms of what would you be looking at the monthlies? How far out would you be looking? Or are you just looking at the weeklies and just kind of managing it and rolling it over on a weekly basis? How do you approach something like that?
Yeah, so kind of like you laid out with just the different dates. That's really kind of how I would start. So if you're taking a look at Powell, I'd look at those Friday expirations. Again, I've talked about this before of why do I do the weeklies versus the monthlies? Well, if you think that Powell's going to come out on Friday morning and he's going to potentially smoke the market, it's not going to be a huge amount of premium. But why would I want to go out and pay for premium with next week's expiration when I can pay less and potentially get a greater return if I think that Friday is going to be the big day that we go down? So in that particular case, and again, you've got your theta or time decay that you just mentioned. So In that particular case, in a way, I'm kind of looking to maybe hit a little bit of a double to triple on a Powell play. You're talking short term. You know exactly what your time frame is. You know exactly kind of what your upside and downside, more what your downside is of your premium that's going to be paid. So I'd look at the Fridays. And in that particular case, if I was saying, hey, Powell's going to smoke the market, the Qs might get hit a little bit harder in that case, right? In theory, if we look at past events like that, the high growth tech gets hit a little bit more.
A little bit more interest rate sensitive, right? So
yep, exactly. So in that particular case, I'd probably go and I'd look at the chart and looking at the Qs here real quick. I wouldn't be, if we took a real big hit, call it a couple percent. Let's just say he really smoked the market, right? And we're trading at 328 and change. Let's say, we got a 2% hit. You're talking, let's call it $6 just for easy math's sake. So you're going to be talking down in the 322 range as a potential target. So, maybe if you want to keep it conservative, maybe you look at Friday's 325 on the Qs. And oddly enough, and this is also just partially because Wall Street likes round numbers, the 325s are the most actively traded contract today. So in a case like that's probably would be along the lines of my thinking. If I really think that he's going to smoke the market, then you can obviously adjust accordingly and go further out of the money. I wouldn't go too far, because then if it doesn't move enough, then you've made the right decision, but you haven't made money. And then at the end of the day,
do you generally go out of the money on that, Brandon? Do you ever do in the money like you would do like the 328 or anything?
I almost never do in the money. And that's just because, if you truly think that the market is going to get smoked because of Powell, I don't see the reason to pay that extra premium for the 328. If I truly think that it's going to go down 2%, then I just don't want to pay that extra. That's just how I manage options trades and always have. So there are some times where I might be close to the money, and that's just strictly like Apple. Sometimes when it trades, you've got your 172.5 strike and your 175. I might really like Apple, but I might not think it's going to stretch that high. So in that case, it might be in the money, but it's kind of rare for me.
Okay. So when you're looking at this, like what kind of size do you try to match up with your portfolio? I mean, do you worry about trying to get a dollar for dollar match there? Are you just looking to offset like some potential losses?
I'm not looking to do the whole portfolio per se. I mean, if you were to go dollar for dollar, I guess in theory you could sometimes rack up quite a large trade in the options front. And the thing with options too is $1,000 trade is going to get you, let's call it 10 contracts or so of that 325. If that thing ends up moving and it went to, let's call it 322, the number I just gave, those at a minimum are going to be worth $1 a piece. So I mean, you'd turn $1,000 into $2,000. So from percentage wise, the way that these move, I always think kind of less is more on the options front. And if you're doing it as a hedge too, hedging with options can add up quite a bit. If you're buying a ton of those contracts and they're expiring worthless, it can start to make a dent.
Yeah, no, that makes sense. So, and to be clear, we're just throwing out hypotheticals. I'm not looking for Powell to take down the market. I'm just looking for different scenarios that I know people who are bearish are probably looking at. So, just trying to throw real life examples on the radar. So your preference would be the Qs just because for Powell. Now, if it was the earnings side of things that had people concerned, and we got like a clunker from Walmart and Target and everything like that, would that switch gears for you and you'd look more at the SPY, since more of those consumer discretionary spending names would be in the S&P?
I would, yeah. I mean, I almost think if Walmart had a clunker, you'd almost think that the tech stocks would just continue to win, right? You know, you'd think that more people would buy Microsoft and sell Walmart, even though they might already be loaded up. So in that particular case, yeah, like HD, Walmart would probably be more on the SPY side. And, you know, that's actually a good point. You know, if you're looking to play, you know, in overall earnings, I've mentioned that I don't like to hold options into earnings just because of the high premiums and the guessing game. But if you wanted to make a play on a potential market moving earnings report, so I'm talking like, you know, Apple, Meta, it's got to be some of the bigger names. You could play the QQQ on a Meta or an Apple into that report, pay a little less on the premium and still get a nice move. So that is one potential way to play earnings if you're ever looking to. And again, I wouldn't, you know, if like I don't know, Roku
Premiums are
comes
so
out.
expensive around earnings, though, right? Does that make that difficult?
I mean, that's part of the reason I don't trade them is you get a 7% move in a stock and your options just haven't paid out. You would get some probably slightly elevated premiums around, you know, things like the Fed and a big earnings like that on the SPY and the QQQ, but they're going to be definitely cheaper than on the individual stock. And it would need to be a big stock, like something like, you know, Roku. You know, they're not going to necessarily move the Qs 1% like Apple did.
All right. So let's take a look at that second example then, Brandon. And, you know, June 1, you think that we're going to hit default. You think that it's going to be a difficult time in the markets, but they'll figure something out and it'll whip back. So you don't want to sell your stocks, but you are concerned that that headline risk is going to lead to a bit of a flux out the window of investors. So, you know, if I'm just looking at this, you know, let's say that I think it could get down to the daily pivot around 318, or and I'm looking at the Qs, or maybe even drop as much, give up some of those March and April gains and come back down to the 305 level. How would you be playing that? Like, because obviously we're looking at it the end of May, so you got to go through Memorial Day weekend and everything like that. Would you be looking at the June contracts for a play in that, or would you still be looking at the weeklies, rolling it over the next couple of weeks, like I know you'd like to do with some of your other options plays? How would you approach that move?
Yeah, so if just using that as kind of the larger kind of macro picture, as just an overall portfolio hedge, I'd probably just go to the Junes. You know, if you're really worried about headline risk, the debt ceiling, or just earnings, or just the market in general, and you want to have a hedge on, you know, there's nothing wrong with buying an option every, you know, Friday and keeping that on until you feel comfortable, and, you know, you can roll those accordingly. You know, that's not something that I do, but if you always want to hedge on because you're worried about that, that is one particular strategy, and you can adjust your strikes each week based upon what the market's done. If you're just talking the debt ceiling, call it, you know, June 1, you could go right out to the June monthlies, which is on the 16th. You know, for me on the Qs, I like to use different technical stuff as targets. So you had mentioned like the 318 area, I think. I mean, for me, just a quick glance, I'm looking at the Qs. You got the 20-day around 320. Again, you got your nice round number. So you're going to see, generally speaking, more contracts traded on that. So you'll have plenty of liquidity. You know, I'd probably keep that on there. And, you know, maybe as we got closer, you know, if we were going to go to drop to the 305, if we did hit that 20-day and you were in that contract, it's going to have done its job and you'll probably be up a pretty good amount. And then at that point, and this is part of the reason that I roll, is you've got the flexibility then. So, you know, let's just say you went out and bought, I don't know, 5 contracts. Let's say 3 contracts at almost $4 a piece. So, you know, call it $1,200 in protection. at that time, you've got the option. Do I think that the debt ceiling is going to create this huge recession? Did we actually default? Is the chart falling apart? You can roll down and you can adjust accordingly. You can trim. It gives you a lot of flexibility. Or if you think, you know what, I think everybody's come to their senses and we defaulted and I think that everything's going to be fine because we realize we got to fix this, you could just take the position off. So again, that's kind of why I like to have multiple contracts and the ability to roll down. So that's probably what I would look at if I were looking at the Qs for June.
Okay. Very similar with SPY, obviously.
Yes. In that particular case, I think if things really went wrong with where we are, 405, 400 seems a pretty reasonable target, I would say.
Right, just slipping below the 20-day, getting right into that S2 level.
Yeah, I would agree. So, again, I might look at maybe actually, I'm just looking here real quick. Oh, sorry, I was looking at the wrong side. So, yeah, like the 405, the 400 calls. Again, the nice thing with the SPY and the QQQs is they're the most heavily traded options contracts out there, I believe. So there's plenty of liquidity on almost every strike. That reminds me, I would throw this out there. When you look at these, especially if you start looking at the dailies, you're always pretty close to your line of vision. And by that, I mean fairly close to around the money because they expire every day. You're going to see contracts that are going to cost you a penny, 2 cents, 8 cents. And it is very, very tempting to see that and say, oh, well, let's just go.
Ticket.
Yeah, there's my lotto ticket. And in certain cases where you get those good, really strong breakout or breakdown days, are those option contracts going to pay out nicely? Absolutely. Those would be a home run, but those are going to be few and far between. So it's just, I think it's very easy as a trader, especially when new is, if you look right now, on the SPY, and this is today's expiration, so you've only got 2 hours left. There's 3 contracts sitting right in front of me near the money that are less than 10 cents. And it gets very tempting to pull the trigger on those and just know your risk and know your odds, really.
So we'll come back to the daily. So just for clarification here too, Brandon, they trade from 8:15 to 4:15, right? 8:15 a.m. to 4:15 p.m.
I believe it's
SPY and Qs.
I believe it's 9:30 to 4:15.
9:30 to 4:15. Okay, I thought I saw something about 8:15.
You might be right on that, and I can double check that. Sorry. That's probably a good point too. I would take extra caution trading these in the after hours. That's where your games are. I mean, think about Apple comes out with that strong earnings, big pop, and then the fade, and then it started to climb back up. Well, if you were in a call on that and you didn't get out right away, they brought that down. And by the time that contract would have expired, if you were in the same day, it probably didn't climb back up enough because the climb, I think, started at 4:15. So, just take caution in that. And again, as we talked about, the market makers, this isn't their first rodeo. They know what contracts are out there, and they will swing the SPY and the QQQ in order to make contracts expire worthless.
Yeah, well, I was just curious because 8:15, that's obviously could be a very pertinent time if you're getting a big econ data point, right? Like I said, jobs is coming out at 8:30 or CPI or something like that. And then just the fact that it does go a little bit into the close, but it's not 24 hours like futures. It's the one thing that I would certainly point out to people if you're kind of choosing between using futures or options on that trade. All right, let's go to the third scenario, Brandon, where you're very bearish. You think that the economy is going to go in the crapper. That we're going to default. That the regional bank situation is going to continue to fan out and spread, and we're looking at poor Q2 earnings, and you kind of looking at us going back and testing those October lows from 2022 around the 360 area in the SPY. How would you approach something like that if you were number one, you're probably cutting some of your stocks anyway, so you're not really necessarily looking for a hedge, I guess, in that scenario. But you know, looking longer term out, I guess would be my question. How would you approach something like that if you did want to use options?
Yeah, so something to keep in mind there, you know, let's just take a quick look here. Let's call it the September monthlies on the SPY. So if you were looking at the 400 strike, I mean, you're talking about 11 bucks, so $1,100 per contract. So, you know, the further out you go, obviously, the more premium that you are going to be paying, which, you know, depending on how large you go, if you only do one contract, again, that doesn't necessarily give you that flexibility of the trimming per se. So that's something that I'm mindful of. You know, for me, I would probably not want to go all the way down to the 360s, just because, you know, if we fall, obviously that's going to pan out very well. I'm more of maybe a meet in the middle kind of guy, because
But
then
that's an important concept. You know, just because you think it's going to go to a certain level doesn't mean you feel the need to play it, basically, right?
exactly. And for meeting in the middle, you know, again, I roll options a lot, and I know that this has kind of been a new concept for a lot of traders out there. If you have that flexibility, you know, I'd rather be in the 390 contract than the 300, because I was trying to hit a home run. And guess what? If my trade goes in my direction and we get down to that 390 level, well, I'm most likely going to be profitable. That gives me the flexibility, if I'm still bearish and the charts still look bad, that I can roll down. So, you know, if I'm looking, hey, I think, you know, the 360 level is reasonable. You know, 400, 405, you've got a major level of, you know, support, and then you've got a major moving average. In a case like that, you know, maybe I just meet in the middle and I'd look at like the 380 strike. So again, that gives you that flexibility where you're not necessarily looking to hit that home run, but you've got yourself protected. And I'm a technical trader. It's a very reasonable technical target as well. And sure enough, if I look at the September 380 contract, it is the like second or third from quick glance highest traded contract on the day. So it's already had 1,800 contracts traded. So you've got plenty of liquidity. It's got like almost 40,000 on the open interest. So again, plenty of liquidity. And in that particular case, you're going to pay about $7 per contract. So there you could probably buy at least 2 contracts for a little bit more than, you know, the 400, and you've still got protection. And if you're bearish in that way, your targets make sense from a technical charts perspective.
All right. Now, of those 3 options, Brandon, I mean, do you have a preference on any sort of, will it just completely matter on, you know, where your mindset is, or do you try to keep within a certain time frame if you're doing something like this? Meaning you wouldn't want to go more than 2 months out just because you don't feel like you're Nostradamus and could guess that far into the future.
Yeah, I will say that I found dealing with longer dated options, this is just a personal thing, a little harder to manage, because I kind of kept telling myself, I've got more time, I've got more time. So, and also just paying some of the premiums, and I don't know, maybe it's the millennial in me that, you know, loves to, you know, play the lotto every day on the shorter time frames. You know, so for me in that particular case, I might not go to September, because if things are really going to hit the fan, I think with the debt ceiling and everything, I'd probably say to myself, well, you know, we've got the summer seasonality. Maybe people are just going to, you know, walk away. Things are going to hit the fan sooner rather than later. I'd probably, you know, move that time frame in again, just to, you know, pay a little less premium on my option, because if it's going to happen, I think it's going to happen. I think looking at it too, with the Q2 earnings, there's so many other things that we have to get through with, Fed speakers and debt ceiling before that even happens, where I'd rather try to maybe make a little bit of money. And like I talked about, adjust my option accordingly. Maybe I do June as my protection. And then if it works out well and I'm still bearish and I'm nervous about earnings, well, then I've got that flexibility to adjust accordingly, take the position off. And, I didn't pay as much on my premium because I didn't go out as far.
Yeah, that makes sense. So let's talk about something that obviously isn't as far out. And that's the 0 days to expiration, the options, the 0 DTEs that have really been just kind of taking the option trading world by storm here. A lot of people, a lot of retailers use it. Retail traders using them. A lot of institutional traders have picked up, and it's been blamed for a lot of the whippy volatility that we're seeing here. Now, I don't believe you trade them on a regular basis. So I was curious, is that something that you're looking at a little closer to maybe start trading? Or what's your thoughts on these 0 days to expiration plays?
Yeah, they've definitely become a whole nother animal. I mean, you're talking the at the monies right now on the SPYs alone are trading in 460,000 contracts so far today. That's just one strike for one day. So I would definitely say part of the whippy action. And yeah, I used to trade at these in the past. I haven't recently. It's something that I'm starting to study and revisit. And I think soon enough, I'll probably start throwing out some recommendations, because I do think in a lot of cases they make sense. You've talked a lot about some of the price action not making sense, and like today, you've got semis that are up. Apple's flat. You got this that's red. This is green. This sector. This you got Dow and all sorts of different things. In that case, trying to figure out the individual price action can get a little choppy and it can be whippy. And one day something is doing this and the next day it's doing that. And that's just part of the environment. In this particular case, if you're looking at these, just study one chart. There's nothing wrong with trading one instrument and trading it well. So it's not something I've done. With the 0 dateds now available, it's something I'm revisiting. So might see some recommendations out there. Again, it gives you plenty of options, no pun intended. There's a lot of liquidity on all the strikes. I would just, again, I would caution to, if you do it every day, you are literally taking a lotto every single day. And I would just manage that and not treat it as that, and use your technicals and your price targets for your entries and your exits. And in this case, I would not be scared to take profits or losses sooner rather than later. I mean, I was looking at one strike earlier and it had whipped between 40 cents to 80 cents, I think 4 times before lunch. So, just make sure that you're protecting yourself from these quick moves.
How do you find the pricing on these?
Pricing, I mean, you're talking 1 cent spreads at the money, up to, I think, 7 cents or so, 7-10 cents from a quick glance. So yeah, again, this is kind of the nice thing, if you look at a lot of stocks out there, there are actually a lot of stocks out there that don't trade a ton of options, and in certain cases have dried up a lot. Like you had mentioned, Beyond Meat, I think it was the end of last week after their earnings. Yeah, that thing I think used to trade like 100,000 contracts a day, and I think it trades like 10,000 a day now. So you don't
Sounds like their revenues.
Yeah. No kidding. So, even on the put side, which would have paid off quite nicely, some of that stuff has dried up, and you get plenty of that liquidity, and you have, your pricing. You can buy at every single even number on the SPY and I believe on the QQQ. That might be a little different if you go out like a year's time, but yeah, every round number that you have out there, you can trade, and there's lots of liquidity. again, just be careful. You pull this thing up right now, and right in your line of vision is a lot of cheap options, and just know your risk and know the odds of those working out in the next hour and a half.
What would pique your curiosity to trade these on a daily basis? Would it be a big event expected, like a jobs report number or Biden making a talk or something? What would pique your interest to trade these? Is it more technical?
Technical and yeah, events as well. I mentioned earlier, like if Apple was reporting, and I wasn't quite sure, or I didn't want to deal with the high premiums, but I thought that Apple was going to have a good report and really boost the market. Or an event, if you thought that Powell on Friday was going to come out and say, everything's fine and dandy, but we want Wall Street to go back to free money because, the market soared, and, you want to just, you want to load up on the QQQs in a case like that. I think that that's a little bit easier. Another thing too, is if you're trying to play overnight gaps, again, a lot of risk in this, but if you look at the studies, a lot of returns in the market in the last few years have come from the overnight period. So, for me, I'll tell you, I've had days where I've looked at the chart and I've said, I think the market's going to get smoked tomorrow. I've woken up, futures have been down 1%. I'm like, oh, this position I took overnight is going to be a home run. And I go and I look and it's up, 3%. And I realize that the company randomly came out and, decided to raise revenue, and it's the only stock in the S&P 500 that's green. So kind of taking some of the guessing game out of the overnight plays is something that I've actually been looking at as well. And again, you'll have overall geopolitical risk, things coming out from our own politicians as well. So you're certainly not without your overall headline risk, but it reduces some of the company-specific risks.
All right. Anything else on that topic then, Brandon, before we end this conversation?
Let me just take a look here. No, I think I actually think we hit on everything that we wanted to go through. So.
All right, we're doing it right in an hour's time frame. I will admit we are trying to keep it a little closer to the 45 minutes, just so it's not too much, but there's a lot of good information going out here. So, as long as we're doing that, we won't worry too much about time. But, I think then at this point, Brandon, will end the conversation for this week. Just kind of recapping things, Brandon, as you said, definitely important to know the makeup of your portfolio if you're going to be using the SPYs or the Qs for trying to figure out which one you want to hedge with. I would say you would say we never want to go too far out of the money, right? You want to get that middle ground, that meet in the middle area, so you're not overreaching and trying to hit those home runs, that you're improving your percentages and looking more at the doubles going on. Anything else, Brandon, that you think is pertinent for this discussion that needs to be restated?
Yeah, I'll actually just kind of touch upon what you just said there as far as going out of the money. If you have a very specific technical target or a reason, I would lean more towards, going to that target. Like I just said, in certain times I look at the charts, I'm playing the 50-day or the 20-day. Like I've got a specific reason for the strikes that I pick. So, if you're charting something, basically what I want to stress there is don't just go and buy the 300 put because you saw it cost a penny. If you think that the market's going to get absolutely destroyed and Armageddon's on its way, and you've got a reason and a technical point for that, well, that makes a little bit more sense. But don't just go and buy way out of the money for no reason, trying to, hit that home run. And if you do try to do that, because, again, if you buy one of those 1 cent options and you get that big move, it will pay off. Just know your risk and, be able to lose that money if you are taking on kind of a little bit more of that gambling risk with these options.
All right, great stuff, Brandon. Great stuff. Just keeping an eye on. We are slipping a little bit lower here as the session moves on. Got the S&P down to that 41.31 area. 41.30.25 was the lows just before lunchtime, so it looks like we're going to be testing them. And then prior to that, we got the lows on the session right at 41.27. So we're just within a couple of ticks of testing the session lows here. So, Brandon, thank you so much for coming on. For just as a reminder, we did record this. I am going to be stopping the trader audio so we can pause the recording, and then we will post the replay to the website for anybody that wants to go back and take another listen to what Brandon had to say about these. But great information as per usual, Brandon. Always appreciate you coming on here, and looking forward to continuing these discussions.
Thanks, Gavin. Appreciate the time today.
All right, we'll talk to everybody soon. I'll be back up in audio here in just about 5 minutes.